June inflation alert. Consumer prices rise again. Fed takes notice. Inflation is back in the spotlight, and the numbers are stirring up debate. The Federal Reserve's go-to measure for tracking inflation, the Personal Consumption Expenditures (PCE) index, revealed that consumer prices crept higher in June. This uptick comes as the Fed keeps a close eye on whether new tariffs are starting to squeeze American wallets. But here's where it gets controversial. The latest data came in hotter than most experts predicted, raising fresh questions about what's really driving prices up. According to the Commerce Department's latest report, the PCE index climbed 0.3% from May to June and 2.6% compared to a year ago. Both of these figures surpassed economists' forecasts, which had anticipated a more modest rise. For context, last month's increases were just 0.1% month over month and 2.3% year over year. So this marks a noticeable acceleration. Digging deeper, the core PCE index, which strips out the often unpredictable costs of food and energy, also rose by 0.3% in June and 2.8% over the past year. These numbers are especially important because the Fed considers core PCE a more reliable indicator of underlying inflation trends. Notably, the annual core PCE figure ticked up from 2.7% in May, and the monthly increase was also higher than the previous month's 0.2%. The Federal Reserve has set a long-term inflation target of 2%, and while policymakers pay attention to the headline PCE, they often rely more on the core data to guide their decisions. With both headline and core PCE rising faster than expected, the pressure is mounting on the Fed to decide whether to act or wait. Here's another detail that could spark debate. Prices for goods rose 0.6% over the past year, with durable goods like cars and appliances up 0.9% and non-durable goods such as food and clothing increasing by 0.5%. Meanwhile, the cost of services jumped a significant 3.5% year over year. This split between goods and services inflation is something many analysts are watching closely, as it could signal shifting pressures within the economy. Wages and salaries, on the other hand, barely budged, rising just 0.1% in June, the slowest monthly growth since at least last November. The personal savings rate held steady at 4.5%, suggesting that households aren't socking away more money despite rising prices. And this is the part most people miss. The Fed's latest meeting ended with interest rates unchanged for the fifth time in a row, even as some political voices, including former President Donald Trump, have pushed for rate cuts. The central bank's benchmark rate remains at 4.25% to 4.5%. Fed Chair Jerome Powell emphasized that policymakers are in a wait-and-see mode, ready to respond if tariffs or other factors start to drag down the job market or push inflation even higher. Powell acknowledged that tariffs are beginning to show up in the prices of certain goods, but he cautioned that it's still unclear whether this will lead to a one-time jump in prices or a more persistent inflation problem. This uncertainty is fueling debate among economists and investors alike. Michael Pierce, Deputy Chief U.S. Economist at Oxford Economics, pointed out that while inflation in services remains relatively subdued, thanks in part to slower increases in housing costs, prices for core goods have surged in recent months. He echoed Powell's view that the Fed won't cut rates until it's sure that the recent spike in goods prices isn't spilling over into broader inflation. The market's reaction was swift. After the June PCE report, the odds of a Fed rate cut in September dropped sharply. According to the CME FedWatch tool, the probability of a rate cut fell from 46.7% to 39% in just one day, while the likelihood of rates staying the same jumped from 52.4% to 61%. So what do you think? Are tariffs the real culprit behind rising prices, or is something else at play? Should the Fed hold steady, or is it time for a rate cut to help consumers? This is a hot topic with plenty of room for disagreement. Share your thoughts in the comments below and join the conversation. Consumer spending rises amid inflation surge in June 2025. What you need to know. When it comes to the state of the economy, there's a delicate balancing act at play. Consumer spending is keeping things afloat, but rising prices are starting to weigh heavily on wallets. This tug-of-war between spending power and inflation has been heating up over the past few months, and last month was no exception. While Americans continued to open their wallets in June, they were also met with an unwelcome surprise: inflation creeping upward. Driven in part by tariff-related price hikes that have trickled down to store shelves and online shopping carts. According to fresh data released by the Commerce Department, consumer spending edged up by 0.3% from May, when spending had remained flat. When adjusted for inflation, however, this increase was much more modest, ticking up just 0.1%. At first glance, these numbers might seem small, but they tell a bigger story about how households are navigating a shifting economic landscape. A key indicator of this shift is the Personal Consumption Expenditures (PCE) price index, the metric the Federal Reserve uses as its benchmark for achieving a 2% inflation target. Last month, the PCE index climbed by 0.3% compared to the previous month, pushing the annual inflation rate to 2.6%, its highest level since February. But here's where it gets controversial. Tariffs, which have become a hallmark of President Donald Trump's trade policies, are beginning to leave a more noticeable mark on overall inflation. These taxes on imported goods are initially paid by companies importing products, but the costs often ripple through the supply chain and eventually make their way into the hands of consumers. For example, businesses may raise prices to offset the added expenses or shrink package sizes while keeping prices the same, a practice sometimes referred to as shrinkflation. Despite these challenges, American consumers appear to be holding steady, for now. Personal income grew by 0.3% in June, and the savings rate remained stable at 4.5%, according to Thursday's report. However, economists caution that this resilience might not last forever. Gus Fosher, chief economist at the PNC Financial Services Group, explained in an interview with CNN that the economy has downshifted significantly over the past year. Job growth has slowed, income gains have moderated, and as a result, so has consumer spending. Consumers are still powering more than 2/3 of economic activity, Fosher noted. But you add tariffs into the mix, their associated price increases, and the uncertainty they create, and people naturally become more cautious. He pointed out that durable goods prices, such as those for appliances and electronics, rose by 0.5% in June. While monthly fluctuations can vary widely, this uptick suggests that some of the costs tied to tariffs are indeed being passed along to shoppers. And this trend, he warned, is likely to intensify in the coming months. The core PCE index, which excludes volatile categories like food and energy, provides further insight. It showed that price increases accelerated in June, climbing 0.3% from May, the fastest pace in 4 months. On an annual basis, core inflation held steady at 2.8%. One contributing factor? Rising energy prices. After declining for much of the year, energy costs surged by 0.9% last month, following a 1% drop in May. Similarly, goods prices saw broad-based increases, with durable goods up 0.5% and non-durable goods rising 0.4%. These figures represent the largest monthly jump since January, when post-holiday discounts faded and prices rebounded. While the current inflationary pressures aren't expected to spiral out of control as they did during the peak of the pandemic in 2022, they're still set to pinch household budgets. It's going to feel uncomfortable for many consumers, Foucher said. They'll start noticing that their paychecks don't stretch as far as they used to. For families already grappling with tight finances, these incremental changes can add up quickly. The stock market reacted mildly to the latest round of economic data. Dow futures inched up by 100 points, or 0.23%, while S&P 500 futures gained 0.92% and NASDAQ 100 futures rose 1.33%. Investors seemed unfazed by the mixed signals, perhaps betting that the Federal Reserve will continue to tread carefully in managing interest rates. And this is the part most people miss. While tariffs are clearly influencing inflation, the broader question remains, What does this mean for everyday Americans? Will consumers absorb these costs quietly, or will frustration boil over into calls for policy changes? As the effects of tariffs continue to unfold, one thing is certain: the interplay between spending, inflation, and trade policies will remain a hot topic of debate. So we'd love to hear your thoughts. Do you think tariffs are worth the cost if they protect domestic industries, or do the downsides outweigh the benefits? Share your perspective in the comments below. How Trump's tariffs are impacting inflation and the Fed's decisions. Inflation is on the rise, and it's making headlines. In June, the Federal Reserve's favored measure of inflation saw an annual increase of 2.6%, up from 2.3% the previous month. This uptick is largely attributed to the economic impact of tariffs imposed during President Trump's administration, which are now filtering through various sectors of the economy. Interestingly, this increase in the Commerce Department's Personal Consumption Expenditures price index surpassed economists' predictions, which had anticipated a more modest rise of 2.5%. When we exclude the more unpredictable categories of food and energy, the index still showed a notable annual increase of 2.8%, exceeding the consensus estimate of 2.7%. Economists had been bracing for price hikes due to these tariffs. Analysts from Vanguard pointed out that core goods are expected to show significant growth, particularly in sensitive areas such as household furnishings, recreational items, clothing, and motor vehicle parts. Moreover, inflation is also becoming evident in the Consumer Price Index, CPI, another comprehensive measure of price changes. The CPI recorded a jump to a 2.7% annual increase in June, up from 2.4% in May, reflecting price increases in sectors particularly affected by tariffs, including apparel, electronics, and home furnishings. This marks a rise from a recent low of 2.3% in April, indicating a trend of increasing prices. In response to these developments, the Federal Reserve decided to maintain short-term interest rates in the range of 4.25% to 4.5% during their recent meeting. Fed Chair Jerome Powell had previously indicated that the presence of tariffs was a significant factor in the Fed's decision to refrain from cutting rates. However, it's important to note that underlying disinflationary trends are also at play, particularly in the services and housing sectors. For instance, shelter inflation within the CPI, which often lags behind the overall inflation rate, has decreased to an annual increase of 3.8% after hovering around 4.0% in March and April. Claudia Sahm, the chief economist at New Century Advisors and a former Fed economist, shared her insights with The Hill, stating, "We've seen some real improvement in recent months in some parts of inflation we've been waiting on. Housing services has really slowed, and non-housing services, which is a significant component of the CPI, are showing monthly rates that are at or even below pre-pandemic levels." Despite the rising prices due to tariffs, Trump has been vocal in urging the Fed to lower interest rates. Interestingly, during the recent meeting, 2 Fed governors expressed dissent regarding the decision to keep rates unchanged, while 9 other members supported the motion. This marked a significant moment, as it was the first time since 1993 that 2 governors diverged from the majority opinion, highlighting the traditionally independent nature of the central bank, and suggesting that Trump's pressure may be influencing its decisions. What do you think about the current inflation trends and the Fed's response? Are tariffs truly the main culprit behind rising prices, or is there more to the story? Share your thoughts in the comments.